Hello and welcome to the May episode of First Look ETF. I'm Stephanie Stanton with ETF Guide. It is great to have you with us. Coming up on today's program, we'll examine a new ETF that targets floating rate bonds, a unique area of the bond market that allows for higher income as interest rates rise. We'll also analyze an ETF that aims for steady income in the energy sector. And finally, we will tell you about a new actively managed bond fund built to help income-focused investors navigate today's economic challenges. But first, as always, to kick things off, we've got Douglas Yones, head of ETFs from the NYSE. And Douglas, it is great to see you as always.
Thanks, Stephanie. It's great to be back.
So let's begin, as we do, with the latest update on ETF launch activity. How's everything looking?
Yeah, I mean, we remain as busy as ever here at the New York Stock Exchange. Last month, 34 brand new ETFs entered the market, raising over $440 million in new assets under management. So for those of us that are sort of tracking totals, we now have close to 3,500 ETFs here in the U.S. with about 8.6 trillion with a T in assets under management.
Truly, truly remarkable. You know, exchange-traded funds, they used to be synonymous with passive index investing, but it feels like the arrival of active ETFs, seems to be sort of changing that dynamic. Tell us a little bit more about that.
Yeah, it certainly has. And we've talked about it on this show, since the very beginning, about the trend around actively managed growth and actively managed ETFs. Listen, keep in mind, 4 out of 10 ETFs this year are still launching using indexes. Index business is certainly not dead. And look, index ETFs have the majority of assets, but the trend around active management is real. It continues to change the industry. This year, 68% of all launches were active, but more importantly, coming off a very small, right, there's not that many of them, a third of all cash flow this year in ETFs is going into actively managed ETFs. The total right now is about 8 billion with a B in assets under management. So look, assets continue to leave the mutual fund structure, enter the ETF structure, whether it be for lower cost, more tax efficiency, ease of use. And the reality is the best active managers are coming into the space. We're going to talk about it in this show, just like we've talked about it in previous episodes.
Yeah, absolutely. Viewers need to stay tuned for that. Before we let you go, what other noteworthy trends in the ETF marketplace are you guys monitoring?
Yeah, one of those trends we've talked about, Stephanie, is that mutual fund to ETF conversion. We continue to see activity. We had 2 more of those come in April, bringing the total now to 7 ETFs this year, converting over $1 billion thus far in 2024. Some of that's going to come up on the show as you watch later on. Also, we talked about active. How about fixed income? The equity markets have done relatively well this year, but yet fixed income bringing in, again, almost a third of all cash flow. So we're still watching these trends, but again, as always, it's education. If you're here and you're listening in and you're learning, don't end the journey with just Stephanie today. Go to etfcentral.com, follow our YouTube channel, follow our podcast, the ETF Central podcast, and learn about the certified ETF designation. It's built for everyone. Please go continue to learn. The ETF industry is fun, it's exciting, and it's all there for you, all available. Follow us on all of our channels.
Yeah, absolutely. So much great information. As always, let's leave it there. Douglas Yones, thank you so much for the update. Keep up the good work, and we will see you soon.
Thanks, Stephanie.
And just a quick reminder that besides YouTube, you can also watch First Look ETF on Apple TV, Amazon Fire, and Roku. We also simulcast First Look ETF on iTunes, Spotify, Amazon Music, and other major podcasting platforms, so don't miss it. Investors like floating rate bonds because of their flexibility to reflect the current market interest rates. Now, if the interest rate of the benchmark rises, the interest rate payable for the floating rate bond rises as well. A new floating rate bond ETF from Regan Capital targets this area of the bond market. And here to explain further is Skylar Weinand, founder and CEO, as well as CIO at Regan Capital. Hi, Skylar. It's great to have you with us. So the Regan Floating Rate MBS ETF, and that ticker is MBSF, is your very first ETF launch. Congratulations. Tell us how the fund works and what makes it a unique investment opportunity.
So we're investing only in mortgage bonds backed by the U.S. government, Fannie, Freddie, Ginnie, which is over a $10 trillion market. About $400 billion of that $10 trillion is in floating rate securities. These are great because they offer up almost zero duration, about a half a year duration. And these bonds are currently yielding upwards of 1.5 over T-bills and money markets. So because banks and the federal government have stepped out of mortgage bond investing for the past few years, these floating rate bonds, which reset monthly, their coupon resets monthly, the principals guaranteed by the United States government offer up to about a 6.5% current yield, at least a point over where money markets are yielding right now.
So tell us a little bit more about some of MBSF's holdings and portfolio weightings. What type of investments can investors expect to see inside the fund?
Well, given that these assets are guaranteed by the United States government, Ginnie Mae, Fannie Mae, and Freddie Mac, which the government took over in 2008, these are all either government direct owned enterprises or government sponsored enterprises. So you're looking at zero credit risk. You're looking at coupons that reset monthly. These are all floating off of SOFR, used to be LIBOR, and you're getting paid upwards of a point to 2 points a month in principal. So you're looking at getting back your full investment within 4 to 5 years. And because the coupon resets every month, you have almost no interest rate risk. The average duration on these securities is about a half a year. So we're going to mix it up in terms of whatever's cheap, whether it's Ginnie, Fannie, or Freddie at any given time frame. We're focusing on assets that have been around for 5 to 10 years, where the underlying borrowers are paying at least a 5% coupon on their mortgages, and almost everything's trading at a discount to par. So at 97, 98 cents on the dollar, you're getting over a 6% yield. And even if rates do drop a point or two, as they're expected to do over the next 2 years, you're still going to get a healthy 5.25%, 5.5% yield. No matter what happens, though, with interest rates, you're going to pick up a point to a point and a half relative to fixed instruments like treasury bills or a money market account.
How do you see a fund like MBSF being deployed by investors and financial advisors?
There's currently over $6 trillion sitting in money markets. And folks think money markets are just a cash account or a savings account. But no, they're really invested in bonds, zero coupon treasury bills. Okay, so if you can pick up a point to a point and a half and stay floating rate, so if rates go up or if rates stay the same, you're going to pick up even more than a point to a point and a half. We're looking at this fund, MBSF, as a really good cash replacement. If you're sitting in 5, 6, 7% cash, you should be looking at potentially putting 1, 2, 3% of that in what we're doing or other floating rate ETFs like MBSF.
All right, we'll leave it right there. Thank you so much, Skylar Weinand, for dropping by First Look ETF.
Thank you.
The energy sector has been among this year's top performing S&P 500 industry groups. And the timing is good because a new fund called the Enhanced Midstream Income ETF, ticker MDST, aims for high and steady income in the energy sector. Well, here to elaborate is Parag Sanghani, Senior Portfolio Manager at Westwood ETFs. Hello, Parag. It's great to have you with us.
Thank you for having me.
The Enhanced Midstream Income ETF, ticker MDST, is your firm's latest ETF launch. How does the fund work and what makes it a unique investment opportunity?
Yeah, absolutely. So what we look at and what we do here on the team is invest primarily in energy across the board. MDST specifically focuses on the midstream sector within traditional energy. The midstream sector are pipeline storage facilities, real assets in the ground that generate cash flow not from the commodity itself, but from transporting the commodity from where it's produced, the oil and gas produced in the fields, to the refineries and the utilities and to the export facilities to get them out to the marketplace. The great thing about midstream is that the fee structure is not commodity sensitive. They get paid a fee per barrel to transport those commodities to their ultimate destination. And these companies actually generate a lot of cash flow, which they then turn around and pay out to shareholders as dividends.
Yeah, that sounds good. So what are some examples of MDST's holdings and how are its portfolio weightings allocated?
Yeah, absolutely. So the portfolio itself owns a large number, about 20 to 25 companies in the midstream sector. And those companies typically pay right around a 6 to 6.5% dividend yield. In addition to that, in this environment where oil and natural gas in particular have recovered from COVID trough levels, what we see is an opportunity to capture a little bit more income by using calls on top of our portfolio to generate an additional roughly 6% per year in premiums. So the combined 6% dividend yield of the portfolio companies with the premium from options, we're generating double-digit income from this portfolio, which we're then paying out to investors on a monthly basis.
So on that note, what type of investor would a fund like MDST appeal to?
MDST is a great addition to an income portfolio. The strategy is actively managed, and we try to pick the best companies within the midstream industry, those that are growing their dividends over time and returning capital to shareholders in a healthy fashion. And we believe that rounding out an income portfolio with an allocation to MDST makes a lot of sense in investor portfolios.
All right, we're going to have to leave it there. Parag, thank you so much for joining us. It's great to have you.
Thank you.
The bond market has been dramatically reshaped over the past few years, and behind the shift has been aggressive rate hikes by the Federal Reserve. So what are some of the challenges now facing fixed income investors? Well, here to discuss that, along with a newly launched actively managed bond ETF, is Vishal Khanduja, co-head of Broad Markets Fixed Income at Morgan Stanley. Hello, Vishal. It's great to have you with us.
Good afternoon. Thanks for having me on.
So the Eaton Vance Total Return Bond ETF, and that ticker is EVTR. This is among your firm's latest launches. Before we delve into the details of that, first of all, tell us what are some of the challenges facing today's generation of bond investors?
No, you stated it really well, Stephanie. I think if you take one more step back, if you will, there's been a clear regime shift happening in the fixed income market. Again, 2009 to 2020 was a very clearly a low inflation volatility event or regime that we were in. And that led to persistently low yields and spreads in the fixed income market. Again, the dominance of price insensitive Fed that was very omnipresent in the market led to some of that. And that also the byproduct of that one was the dispersion in returns and risk within sectors or among sectors in fixed income market was very, very low. You clearly pointed out there was a pretty market event in 2020, pretty drastic rate rises that went on in the fixed income market. What was leading that was the inflation was moving, spiking higher. I shouldn't even use the word moving. And inflation volatility was following right behind it. That has had a clearly an effect on the fixed income market where sectors and securities are not behaving in that same unison effect that they did for the last 15 years from like 2009 to 2020 in that sort of regime, if you will. So that has led to a new sort of, I would say, era in fixed income market where dispersion and correlation of sectors has definitely changed. That is causing uncertainty of what returns would be in fixed income market, what volatility would be, and what investors should expect out of it. That uncertainty, I think, is the biggest challenge right now for the fixed income market and investors at the moment.
Interesting. So again, let's dive in now to EVTR. We do know that it is actively managed, but tell us a little bit more about it and how it differs from the traditional core bond index ETF.
We strongly believe, I think, that the debate between active and passive in fixed income is, from our vantage point, has already been settled. So not only the basic construct of these indices have been driving that debt weighted is philosophically at odds with what debt investors are actually looking for in their investment, and I think they constrain themselves even further at the pretext of reducing the cost that they have on the other side. So that is a very critical point for investors to consider, especially in their core fixed income allocation, as typically that is one of the biggest allocation that investors have in their diversified portfolio. That was sort of our starting point of thinking about an active fixed income portfolio longer term. And why we say that, if you look at an index fund, it has close to about 35 odd percentage of low yielding, lower coupon agency mortgage-backed securities. That sector overall is very attractive, but that specific subsector or sub-portion of that sector is almost like a suboptimal way to allocate within the fixed income land. So if you think about EVTR now, or Edenman's Total Return Fund that we are managing here in an active fashion, we have 250 individuals on the investment team across the globe. The concept is that they are sector specialists looking for best ideas within the fixed income land. So what that does for us is expands the opportunity set. And after expanding that opportunity set, we are looking for the best ideas in that expanded opportunity set to build the portfolio for clients. So EVTR in one way would be our team's best foot forward from a macroeconomic positioning standpoint, sector correlation or sector ideas. And then most importantly, it is a very bottom-up, a diversified multi-sector fund that we manage, so that it gives the reflection of our entire team's best ideas in one vehicle, and does it in a very sort of tax efficient, all the benefits that ETFs provide in a very tax efficient fashion. And in an actively managed high volatile period, I think that tax efficiency comes very handy, especially for investors.
And it is nice how you said sort of putting great minds together, your best foot forward, so to speak, across all of your staff. So that's an interesting point. So then, with that being said, how do you see investors and financial advisors using a fund like EVTR inside a diversified portfolio?
The normal way, I think, we've seen financial advisors, and there are various ways that they've used within their overall portfolio. But the most commonly used one is this is our fixed income allocation. Why don't you and your team focus on moving us around in terms of what sectors you think is the best allocation at any given point, and then the best securities coming into the portfolio. There's a standalone full allocation, in a basic format of 60-40, we are managing their 40% of fixed income allocation. So that is one most dominant way of utilizing EVTR for financial advisors. The other way, and this goes back to the construction of our EVTR portfolio, is it is a best ideas sector agnostic. We are not incentivized to hold a sector just because it's a dominant portion in a benchmark. So we do travel around sectors. If you look at a sand chart of our portfolio over the years of sector allocation and duration contributions, it'll show that, traveling across, seeking that best value within the fixed income market. So that allows us to be paired really well with an index fund if a financial advisor holds it, or another sector dominant fund if the advisor holds it as a portion of their fixed income allocation. So we've been used, or EVTR has been used as a pairing with other sort of fixed income allocations that the client would have in their portfolios.
Vishal Khanduja, Morgan Stanley, thank you so much for joining us here today and sharing more about EVTR. It's great to have you with us.
Thank you so much, Stephanie.
And that does it for today's episode of First Look ETF. If you enjoyed the show, tell us in the comments section below and by hitting the like button. Want to give a big thanks to all of our guests, along with Douglas Yones from the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thank you so much for watching. We will see you next time.